Hello and welcome to the channel. My name is Zach Collins and this is Financial Education. So today what I want to do is I want to introduce you to the topic of ETFs. Now, before you get confused, I'm not talking about transferring money via EFT, electronic funds transfer. No, what I'm talking about is ETFs, which stands for Exchange Traded Funds. Now, if you've never heard of this before, what is an ETF? So to put simply, an ETF is a basket of goods. Think of like a little hamper. So when you buy a hamper, you get some different samples, say chocolates, maybe some soap and shampoo, some fruit and nuts, etc. You guys get the point. So an ETF is basically the same thing, but it's a basket of shares. Just like with the hamper, you don't get the full-size box of chocolates, you get a little sample. Now, don't be alarmed, you're not getting an inferior class of shares, you're just getting like a smaller parcel. So, like I said, ETFs hold a basket of shares. Now, this basket has a rule that it follows, which dictates what it holds. So this could be Australian shares, international shares, corporate bonds, government bonds, or a mix of any of the above. It could be thematic in that only holds tech or property or banks. It could be index tracking in that it picks an index, say ASX 200. ASX 200 is the largest 200 companies in Australia. It could be something that tracks the S&P 500, which is the largest 500 companies in the US. It could be an active ETF in which the fund manager picks an index and they can pick and choose from that index what they want to do with it. They can follow it or not. Basically, what I'm trying to say is that there are a lot of options that you can pick from if you want to buy an ETF. Now that you get the basic idea of what an ETF is, I'll dive into a few different terms that I just used, which may have confused you, if it's the first time you've heard it, and that is index and active investing. So, what is an index fund? So an index fund, plain and simple, is a fund that follows the index. Now there's hundreds of different indexes and they all track different things. So an index could be, in Australia, the popular one is ASX 200. You've got the S&P 500, as I mentioned above. You've got the NASDAQ 100, you've got the Nikkei, you've got the FTSE 100, you've got just countless of other different countries and indexes, and you know what? There's just so many. So right now, let's dive into the top 10 companies of the ASX 200. Okay, so here I am on Market Index. Now, this is a great free resource, and it gives you a rundown of basically what happens on the day. You can also look at what happens in the last 3 months, 6 months, 1 year, so on and so forth. Now, what I'm looking at right now is the S&P to the ASX 200. So this is the top 200 companies in Australia. So what I'm going to do now is I'll go down and we'll look at probably the top 10. So I'm just going to lower fix this by market cap, and so you can see the top bunch here, with the top one being BHP and the second one being Commonwealth Bank. Now we can't see how much each company actually represents of the index itself. If you were to look into the ETF itself and go down to the holdings, they will tell you what the allocation is, but it should 100%, assuming it follows the ASX 200, follow the asset allocation as per this. Now, if we have a look at the bottom company, so you can see is currently Codan, and that is sitting at a market cap of 1.5 billion, which is significantly lower than that of BHP. If you were to buy a ETF that was to track this index, you would have a significantly larger portion invested in BHP than you would in Codan. Now, what is an active fund, and how is it different to an index fund? Let's keep things simple and say one particular share makes up 1% of an index. An active fund manager could make that 10%. That's their choice. Same if anything makes up 10%. They can then choose to drop that back down to 5%. Basically, they can pick any index they want to track, say the ASX 200, and they can pick any of the shares within those 200. They can have all of them, they can have one, and they can allocate as much money as they want to any particular share. There is no rule other than what index they track as to how much or how little they allocate to each company within that index. Now, I've only been talking about percentages so far. Now, that's for good reason. So there are many different ETF providers, but they all use the same or a similar index that they track, but the price of the ETF that you will buy could be completely different. So for all intents and purposes, these different ETFs, as long as they track the same index, they can be considered to be identical. So let's use a bit of an example. So let's say you hold 100 shares. Let's call it ETF A. ETF A costs $100 per basket. Now that tracks index A. I'm only going to pick out two companies from this index. Company A is 10%, company B is 5%. So ultimately, with that $10,000 you've invested into ETF A, you hold about $1,000 in company A and $500 in company B. Now, let's say instead of ETF A, you've now got ETF B. So this ETF tracks the same index. The only thing is that it costs $25 per share. So you still invest that $10,000. The difference here, though, is now you've got 400 shares of ETF B. Because it tracks the exact same index, you'll still hold $1,000 in company A, and you will still hold $500 in company B, same as you would with ETF A. The only difference is you've got 400 of these ETF B instead of 100 ETF A. Now, I say that they're ultimately the same, but there is one thing that you do need to be careful of, and that is something called MER, or Management Expense Ratio. Now, management expense ratio is the fee that they charge you to invest the money. I'm going to cover this MER in a future video, but for now, all you need to know is that when you're comparing the two funds that track the same index, have the same methodology, same as allocation, like in the example I gave before, the fund, they're ultimately the exact same, but the fund with the lower MER is the better choice because the returns will be the same. They're exactly the same. The only difference is the fees that each different ETF provider is charging you. Okay, so now that you know what an ETF is and what it holds, we need to know how you can hold them. So there's two different ways that we can buy ETFs in Australia, and that's either through a custodian model or a chess model. And when I say chess model, I'm not talking about the board game. So custodian model is where basically you do not hold an ETF in your personal name. You have an account on a brokerage and they will hold it in their name as trustee for you. Basically, you're the beneficiary of the ETF. You receive any distributions it pays out. You can sell the ETF whenever you want. You have full control of this holding. The benefit of the custodian model is that trading on these brokerage platforms, they tend to be a bit cheaper than brokerages that use the chess model, or sometimes even completely free. You can also generally hold smaller parcels. So you can sometimes buy fractions of an ETF. You can't do that with chess. You have to buy the full whole ETF. You can invest in $5, $10 here and there versus larger chunks, which you might need to with chess. Now, the big problem with the custodian model is that basically you're relying on the brokerage to remain solvent. Because the brokerage is technically the owner of the ETFs you bought, if something were to happen, if they were to go broke, it is really in their money. And so they can basically take it and sell it and use it as their own. The chess model differs completely to the custodian model, that you are the ultimate owner of the ETF. 100% is it in your name. Now, so chess, it's not the board game, as I said. Chess stands for Clearing House Electronic Sub-Register System. Bit of a confusing name, isn't it? And this register is maintained by the ASX, which is the index provider. Chess registers your name and allocates each parcel of shares that's bought into a distinct account with its own number, which is under a HIN, which is a holder identification number. This will record what shares are yours, and basically it's super easy to move between brokerages. You keep your HIN and you can move it between brokerages whenever you want, basically at no cost. Now, because it's 100% in your name, not in the brokerages, with them as a trustee, if something were to happen to the brokerage, they can't touch it. They cannot liquidate your holdings to basically fund their business. Now, the downsides to using a chess broker is that they tend to be more expensive. So they charge per trade versus custodian, which might be per month, and you can do unlimited trades. As I said before, you also need to buy whole units. Now, this could be in the example I used previously where it was $25 and $100. Basically, if you were to buy one for ETF-B, it would have to be $25 minimum plus brokerage. For ETF-A, it's $100 plus brokerage. So if you only want to invest a small amount, you can see how some people might choose the custodian model. There's also a minimum initial buy-in. So any CHESS holding, minimum buy-in is $500. So this also tends to scare off new investors. Because especially when you're starting out, $500 in something you don't know anything about, it can be considered risky by the people investing it, and $500 is also a decent amount of money. Now, hopefully I've been able to help you better understand what an ETF is, what the underlying holdings would be, and the different ways that you can buy these ETFs. Now, if you have any more questions, please feel free to drop a comment down below. I will answer if I can, and thank you so much for watching. I will see you on the next one.